Hey, it's Mark from Caliber. Hope you had a great 4th of July and you're having a great holiday weekend. I just want to recap the last week and last month and just give you an idea of what rates have done this week and where we think they might be headed. There's some added news this morning from the talking heads and the different financial networks and what they think the Fed's going to do. So let's start with today. So we actually started here, and then there was the jobs report came out at 8:30 this morning, and the report was stronger than expected. So there are more jobs added than were expected, and so that's considered inflationary. Anything that's inflationary causes bond prices to drop and yields to go up. So here you see that the bond prices dropped, and then we started to recover about 10:30 a little bit. We didn't get it all back. We started to recover a little bit after 10:30. So rates are up a little bit for today based on where they closed yesterday. And then for the week, you can see it's been a pretty interesting week. So we actually ended up right about, for the week, ended up right about just a little bit above where we started. So for the week, pricing actually is a little bit better on rates, but not much. But you'll see that there's this big drop. And again, so on Wednesday, the ADP employment report came out, and it was weaker than expected. So rates got a little bit of a boost for that. But typically ADP is not a great measure of employment. It's always off. I'm not sure why the markets react to it the way they do every month. So for the previous month, you'll see that there's still an increase in bond prices over the last month. It's not tremendous, which is keeping rates down. And then since the beginning of the year, we can see that there's still that incline up, which is dropping rates. But let's take a look at this area right here. We seem to be hitting a plateau. We go up, we come down, we go up, we come down. So depending on where this continues out, we may find an issue where we're not going to be able, the bond prices aren't going to move up quite so much. So that will cause rates to stagnate where they are or possibly go up a little bit. Then the Fed meets next week or the week after, and there's some interest. There's some people in the financial networks that are talking about the Fed, instead of reducing rates by 0.25%, they might go 0.5%. I think this is a knee-jerk reaction by the talking heads more than anything else. I think that based on the jobs report, they may actually drop rates a 0.25 point in July, if not then for sure in September, if the trend continues. But I'm not totally sold on the 0.5 point drop. So let's look at this realistically. What happens is when the Fed drops rates, our mortgage rates initially go up because dropping rates is considered inflationary in the long term. And again, bondholders, the only way for them to hedge against future inflation is to raise their yield or raise the amount that they make on the bond, which raises the rate. So in the near term, it may actually, the rates may go up a little bit and then come back down. It's never an isolated situation, depends on what else is going on at the time, but that typically is not uncommon for that to happen. So we'll have to keep an eye on that. Also, real good news came out that Congressional Bill H.R. 299 was passed and signed off on, and that uncaps. It's a VA. It's a bill that deals with the Navy mostly, but in the bill, the VA has uncapped the amount of money that a vet can qualify for and not have to put a down payment. So right now we're capped in Michigan. We're capped at $44,350. So once we get into January, they took the cap off. So that means theoretically, they can get a $1 million mortgage with no down payment and no mortgage insurance. Now, I'm pretty sure that different lenders will put caps on there at somewhere along the lines. I'm not sure. Again, we're 6 months out, so I haven't even seen anything written by Caliber. I won't see anything come out with Caliber until we're closer to the end of the year, until everybody gets a chance to digest this and decide how they want to deal with this risk-wise. But on the surface, it's really good news. So they're no longer going to have a down payment for amounts over $44,350 $350, and they'll still be able to do this without any monthly mortgage insurance. So I'll be around all weekend. Let me know if you need anything. It's going to be a hot one. Drink lots of fluids. MIST is about a week and a day behind in underwriting, and even with rates tempering a little bit, rates are still low. Rates are still really low, and I see prices are going up, and we're doing more renovation loans. So if you've got a house out there, or your buyers are looking at a house that needs work, don't be afraid to have them ask about renovation lending. The rates on our renovation lending programs are very competitive. So, and it's always a great option. So take a look at that also. Give me a shout, 248-705-8431, and have a great weekend.